Here's a summary of IntuitiveSurgical's ISRG Q1 2026 earnings call, designed for a clear and concise read aloud. Introductory remarks. Good afternoon, and thank you for joining us for IntuitiveSurgical's first quarter 2026 earnings conference call. Today, I'm joined by Dave Rosa, our CEO, and Jamie Samath, our CFO. As a reminder, today's discussion may include forward-looking statements. For a more detailed understanding of the risks and uncertainties, please refer to our SEC filings. We experienced technical difficulties with the distribution of our press release today, but you can find our 8K, including the press release, and Q1 2026 financial data tables on our website. Our call will follow this format. Dave will provide an overview of business and operational highlights. Jamie will then detail our financial results and key performance indicators. Following that, I will present clinical highlights and our updated financial outlook for 2026. We will then open the line for your questions. Dave Rosa, CEO Business and Operational Highlights. Thank you. Q1 2026 marked a solid start to the year for Intuitive, driven by 17% total procedure growth, with strong adoption across both our Da Vinci and Ion platforms. Specifically, Da Vinci procedures grew 16% to 847,000, and Ion procedures increased a notable 39% to 43,000. Performance was robust in the US and Europe, though we saw mixed results in Asia. In the United States, Da Vinci procedures saw 14% year-over-year growth, particularly strong in general surgery. This was fueled by a 31% increase in after-hours procedures and higher overall utilization. We're pleased to report that Da Vinci 5 utilization continues to exceed that of the Da Vinci Xi, contributing to a 4% increase in U.S. utilization growth. Outside the U.S., Da Vinci procedures grew 19%, driven by continued strength in general surgery and gynecology, expanding beyond our traditional urology base. The slightly lower growth rate compared to prior quarters reflects ongoing challenges in China and Japan. In China, the environment remains consistent with recent quarters, characterized by relatively low tender activity, domestic competition, and policy-driven pricing pressures. We continue to invest in this market, believing in its long-term opportunity. In Japan, procedure growth improves sequentially but remains below historical levels due to fewer system placements in 2025. However, we are encouraged by recent policy developments, including incremental financial support for higher-volume robotic programs and new reimbursement for 7 additional procedures, both effective from June 2026. Our international strategy is showing progress, with procedures outside the U.S. now representing 38% of total Da Vinci volume, up significantly from 25% a decade ago. We are well-positioned to expand access globally with our XR system and our comprehensive ecosystem. Regarding capital placements, we placed 431 Da Vinci systems in Q1, including 232 Da Vinci 5 systems, 34 SP systems, and 34 XR systems. We also placed 52 Ion systems. Customer feedback on Da Vinci 5 continues to be very encouraging, driving increased clinical throughput and access. At the recent SAGES conference, new data highlighted the objective benefits of our Da Vinci force feedback instrumentation, demonstrating objectively lower tissue forces. We received FDA 510(k) clearance for additional uses of these instruments in March, supporting broader availability starting in Q2. Our digital ecosystem continues to evolve. Da Vinci 5 is capturing surgical data at greater scale and fidelity, informing our AI roadmap, which includes future capabilities like telesurgery and augmented dexterity, all aimed at advancing the quintuple aim. Momentum for our single-port SP platform continued, with procedures growing 68% year-over-year driven by expansion in Korea and the US. We also launched our new SP stapler, which will support deeper penetration in thoracic and colorectal procedures. For ION, we are pleased with its progress. Clinical publications, including a recent Mayo Clinic study, reinforce ION's role in supporting earlier identification of lung cancer, potentially improving patient survival. We are also advancing our rapid on-site tissue evaluation, or ROSE, technology and endobronchial ultrasound integration. Our company priorities for 2026 remain focused on global expansion of our platforms, increased adoption for focused procedures, building industrial scale, and advancing innovation to reach more patients. Finally, I want to acknowledge the retirement of Dr. Miriam Curet, our Chief Medical Officer, after over 20 years. We thank her for her invaluable contributions. I'm pleased to announce Dr. Jamie Wong's promotion to Chief Medical Officer. Jamie Samath, CFO Financial Results. Thank you, Dave. I'll provide a review of our financial performance on a non-GAAP basis. In Q1 2026, total procedures grew 17%, with Da Vinci up 16% and ION up 39%. Total revenue increased 23% to $2.77 billion. Recurring revenue also grew 23% to $2.4 billion, representing 86% of total revenue. On a constant currency basis, revenue growth was 22%. Our non-GAAP operating margin was a strong 39%, reflecting leverage of fixed costs. This performance is driven by the continued global expansion and procedure adoption of our Da Vinci 5, ION, and SP platforms. In the US, total procedures increased 15%, with Da Vinci up 14% and ION up 37%. We saw strong growth in cholecystectomy and appendectomy procedures, up 31% combined. Our investments in benign gynecology procedures are driving a 19% increase in non-hysterectomy benign procedures. However, Da Vinci bariatric procedures declined approximately 10%, impacted by the growth of GLP-1 medications. U.S. Da Vinci utilization increased 4%, higher than recent quarters, thanks to Da Vinci 5 utilization being approximately 11% higher than Xi. Outside the U.S., total procedures grew 20%, with Da Vinci up 19%. Strong results were seen in India, Canada, the UK, and Korea. China remains challenging with below-average procedure growth due to lower tenders and competitive pricing. In Japan, we're encouraged by new reimbursement policies effective June 2026, but remain cautious in the short term due to hospital financial positions. Our SP platform continues to show healthy global procedure growth at 68%. In the U.S., SP system utilization accelerated 22% year-over-year. We've launched our new SP stapler in the U.S., with plans for measured launch in Korea and Europe in Q2. Instruments and accessories, INA, revenue grew 23% to $1.7 billion. Da Vinci INA revenue per procedure was approximately $1,880, up from $1,780 last year, driven by customer ordering patterns, a higher mix of SP and Da Vinci 5 procedures, and FX factors. Regarding capital performance, we placed 431 Da Vinci systems, a 17% increase from last year. 232 of these were Da Vinci 5 systems. We also placed 34 SP systems and 52 ION systems. Systems revenue grew 24% to $651 million. Leasing represented 56% of Da Vinci placements, up from 47% last quarter. Da Vinci leasing revenue increased 28%. Service revenue increased 19% to $434 million, reflecting growth in our installed base. Service revenue per Da Vinci system increased 6% year-over-year. Moving to the P&L, non-GAAP gross margin was 67.8%, an increase from 66.4% in the prior year, reflecting product cost reductions and fixed overhead leverage. While Q1 was not significantly impacted, we expect higher oil and memory prices to have a greater unfavorable impact in the remainder of the year. DaVinci 5 and Ion platforms achieve contribution margins comparable to our SHE system and close to the corporate average, respectively. Non-GAAP operating expenses increased 10% year-over-year, lower than expected due to timing. This was driven by higher headcount, increased variable compensation, and facility costs. Non-GAAP net income was $901 million, or $2.50 per share, compared to $662 million, or $1.81 per share, in Q1 of last year. On a GAAP basis, net income was $822 million, or $2.28 per share. We ended the quarter with $8 billion in cash and investments. Our Q1 results demonstrate innovation-led revenue performance, driven by differentiated products like DaVinci 5, which contributes to higher revenue growth and procedure growth. This trend is expected to continue with upcoming innovations in our SP stapler and AI capabilities. Dan Connolly, VP Investor Relations, Clinical Highlights and 2026 Outlook.
Thank you, Jamie. I want to highlight a recent clinical publication on our Ion platform. This Mayo Clinic study, published in Mayo Clinic Proceedings, analyzed over 2,000 peripheral pulmonary lesions sampled by Ion. It demonstrated a diagnostic yield of 79% with malignancy sensitivity of 85%. Notably, the rate of early-stage primary lung cancer diagnosis increased by 23 percentage points during the study period, from 46% to 69%. The authors concluded that shape-sensing robotic-assisted bronchoscopy is a preferred method for assessing suspicious peripheral pulmonary lesions. Now, let's turn to our updated financial outlook for 2026. We are increasing our forecast for full-year DaVinci procedure growth to a range of 13.5% to 15.5%, up from our previous forecast of 13% to 15%. The primary growth drivers remain consistent: general surgery in the U.S. and procedures outside of urology internationally. This updated range considers potential impacts from ACA subsidies, macroeconomic conditions in Europe, China's tender volumes, challenges in Japan, and pharmaceutical products for obesity management.
Q&A session summary: Digital and Data Roadmap. The company is investing heavily in its digital and AI roadmap, focusing on building a layered set of capabilities from high-quality data. This includes leveraging video data, robotic data streams, and electronic medical records to generate insights that will be delivered to customers through operational guidance, surgeon assistance, and EndoR applications like anatomy identification. Future advancements aim for augmented dexterity and automation. The company believes its extensive installed base and specialized data sets are key differentiators. Gross margin drivers. Strong Q1 gross margins were attributed to revenue growth and product cost reductions. While macro factors like oil and memory prices are being monitored, their impact on Q1 was small. The company expects these to have a greater unfavorable impact later in the year. DaVinci 5 and Ion platforms are achieving contribution margins comparable to previous models. Appendectomy opportunity. While appendectomy is a significant opportunity, the company is still internalizing the specific robotic portion of the total addressable market (TAM) due to its early stage. They are encouraged by emerging evidence of improved clinical outcomes with DaVinci surgery compared to laparoscopy. Japan incremental opportunity. The new reimbursement for 7 procedures in Japan is expected to have a modest impact, and it will take time for procedure volumes to develop. Innovation-led revenue growth. The company explained that innovation-led revenue growth, where revenue grows faster than procedures, is driven by differentiated value from products like Da Vinci 5 and SP. This allows for accretive pricing. They do not guide revenue growth separately but emphasize that innovation is critical to their success. Utilization growth potential. The company sees continued potential for utilization growth, especially in markets like Japan and certain European regions. In the U.S., growth will depend on the transition to Da Vinci 5. They aim to maintain utilization growth as it's crucial for differentiation. Global competition and pricing. Intuitive's competitive strategy focuses on meeting customer needs at the right price, emphasizing the overall value of a robotic program beyond initial cost. The addition of the SHIAR system strengthens their ability to offer tiered pricing and compete effectively with proven clinical results, reliability, and a comprehensive ecosystem. They also highlighted selling both new and refurbished SHI systems, offering tiered capability and economics. International INA growth. Strong international INA growth compared to procedure growth was attributed to customer ordering patterns, potential stocking orders due to strong capital placements, and favorable foreign exchange rates. Future initiatives, telesurgery, cardiac, stroke. The CEO expressed strong belief in the value of telesurgery, particularly collaborative features, and sees it as part of their future roadmap. They are also investing in cardiac and cardiac surgery, believing there are patients who will benefit from minimally invasive approaches. The company remains intrigued by stroke intervention and other areas where they can enhance capabilities and deliver value. They anticipate surgeons will continue to find innovative uses for their platforms. Single-port SP platform adoption. The SP platform is seeing continued procedure growth, driven by additional clearances and instrumentation. The company expects this progression to continue at a reasonable pace. They believe SP offers incremental opportunities beyond multiport, potentially expanding the addressable market, though their current focus is on expanding cleared indications. They are also exploring localized manufacturing and franchising with distributors in international markets. Closing remarks. In closing, we remain confident in our substantial and durable opportunity to fundamentally improve surgery. Our teams are dedicated to advancing the quintuple aim: better patient outcomes, better patient and care team experiences, lower total cost of care, and increased access. We envision a future of less invasive and profoundly better care. Thank you for your continued support on this extraordinary journey. We look forward to speaking with you again in 3 months.